All right, we are done with 2022. Wow, that was just honestly, it was a very challenging year for a lot of people, both buyers and sellers. It was basically a year of two tales. At the beginning of the year, we started really strong. Rates were at low 3%. We saw 11% appreciation by April, May of last year. Just to see the pendulum swing back down with momentum as the rates went up to over 7% and buyers' affordability just absolutely got crushed. And you saw prices come back down, and we ended 2022 with a negative 4.5% in price point for the whole year, which is, of course, nothing. Nobody predicted that. So if you think about who wins, who loses, unfortunately, everybody loses in this case. You have a 4.3% price reduction in 2023, which hurt some of the sellers. The buyers saw an increase in terms. So buyers' payments, even though the price point last year we saw a drop of 4.5%, it's actually 30% higher on the payment. So the buyers also lose. You see an affordability issue. So you see rents because buyers can't buy. They have to stay in the rental market, continue to push up. So pressure in the rental market, as you could see in the CPI, cost of living has gone up. And then you saw a transactional recession. When people can't transact, you didn't see a ballooning of inventory. You saw a transaction correction. So you saw the transactional recession, which hurt a lot of the industry. Inspectors, lenders, real estate agents, a lot of companies and businesses that evolve around the real estate market all got affected. So you're starting to see that happen. So let's take a look at the numbers and we'll dive in to see what it actually looked like. So starting with the first chart here, which shows the inventory. Again, you see the trend line going all the way down. You see the trend line on the solds going down and the trend lines on the pending. Transactional recession. It's interesting when you see inventory low and yet you see demand very high. But if you can't afford to buy a property because the payments went up by 30%, even the property values came down, then you see sellers striking and you see buyers taking a step back and then sticking and dealing with their current rental situation. So here you see the rates starting at the beginning of the year at 3.1%. We saw us peaking in price point around April, and then you started seeing this rate just jump up. You saw this shock of a percentage and a half, a little more than that, and then jumping up all the way to 7%, which caused a halt to the market. You see the median price. It's interesting. The actual price per square foot stayed pretty close. At the end of the year was at 274. We're at 272 now, so it shows a slight change in the median price, but really what you that's a square footage price. But when you look at the median price, that's where you see the big change. So we saw the end of last year, we ended up at 440,000. Again, this is that pendulum that swings up. We were at 485. That was the peak price. We saw it come all the way back down, which ended up being in a negative number, 4.5%. Decrease in prices in 2022, ending at 420. You saw it peak here with the rates going up. You started seeing the prices go down. Median price at 475, 469, 460, 447, 433, 430, and now we did up at 420. We're seeing an uptick of activity. The rates did come down to FHAs at high 5, conventionals at low 6. We'll see what kind of activity what kind of information that gives us and transaction that gives us for January, but it seems a little gloomy. It looks like our crystal ball is now a snowball, right? You can't really predict what's going to happen in the market, but what we do know is as they label a recession, you'll start seeing those CPI numbers also come down, and you'll start seeing the rates come down. So we will see what that looks like in the first quarter of this next year. But when it comes down to days on the market, it's about 41 days on the market. You're seeing a little uptick on the price point when it comes down to what a property is being listed at and what it's actually selling at. We're seeing it at 94% of original list price. Now we're at 95%. A lot of that might be some sellers really starting to price realistically, so you're not seeing as much reductions. You're seeing a lot of closing credits, still buying it, buyers' interest rates down, and a bit more of that negotiation power for the buyer, which does help with some of that payment affordability. If you could get a solid credit with the lender and bring that rate down potentially from 5.8 down up to the high fours, it will increase the buyer's affordability, and they might not see that 30% increase in price, but it all comes down to your ability to negotiate, not always the best price, but the best terms for yourself as a buyer, or if you're a seller, not giving up some of your price, but giving up some credit, so that way you negotiate not a lower price point, but a lower monthly payment for that buyer. So here we're looking at the amount of inventory, again, staying flat. Again, the normal market is 4 to 6 months. We're sitting at under 2 months of inventory. So interesting fact there. We did see foreclosures jump up a bit, but you're looking at 164,000 foreclosures over the U.S. compared to 1.6 million back in the day. So still a tenth of what we had in the past, but we are looking and keeping an eye on that as the recession hits and some people lose their jobs. You will see you will see an increase of foreclosures. So some people might say, hey, we saw 100% activity of foreclosure increasing, but it makes sense because you're at low as you've ever been, so it doesn't take much movement to get to that price point. I mean, if you really look at COVID, like even during COVID or pre-COVID, you were at a 300,000 foreclosures, not just averaged. You just averaged in the U.S., so we're still much lower than we were even pre-pandemic. Why that is because you have equity, so 58% equity on average in the whole U.S. So what happened through this whole COVID crisis is you ended up having the pressure of the interest rates, and you saw the rates come down. A lot of people restructured their debt. So people through this 2020, 2021 market that reset their rates, and they were maybe at 5% prior and got down to under 3%, actually are in way better position today. So their property might not be worth as much as it was at the beginning of last year, but they did lock in a much lower payment. So a lot of homeowners right now are in much better equity position, better mortgage position, very, very cheap debt. So I think that's going to be a signal of strength in the housing market that's coming. So the housing forecast, of course, you see, lower inflation equals lower interest rates. You're going to continue to see a slowdown over the next few months. Incomes are increasing, which is helping affordability, and then you're seeing a very tight inventory environment. So that, again, it's going to be something that's challenging for a lot of buyers. Rents are still expensive and rising. So we will see how this year will shape out. We're going to keep you updated as much as we can every month, and we'll give it to you exactly how it is. But if you're interested in knowing how much your property is worth, or if you're a buyer wanting to see what options you have and what negotiation tools we're using right now to help you get the best terms on a property, reach out to somebody on the team. Until next month, we will talk to you soon.